We encounter a particularly vexing problem when we use historical data to make financial decisions. It's called the black swan problem. That's a rather elegant way to alert us to the realization that just because an event hasn't happened, that doesn't mean that it will never happen. Until the late 17th century, Europeans had never seen a black swan, and people disagreed about whether they existed or not. Some people claimed that if they did exist, then they would have seen one by then. Turns out they were wrong. In fact, black swans were rather common in Western Australia. So, if I showed you a distribution of Dow Jones stock returns over about an 80-year period, you'd see more or less a normal distribution. With most of the annual returns for the year piling up between 10 and 30%, you'd see that the worst annual return would be really bad. You'd have lost about half of your investment in the worst year. But, you might say, that's only half of my investment, not all of it. If that's the worst the stock market can do to me, then I can handle that. If you say that, then you're making a mistake. That's not the worst that the stock market can do to you. It's the worst we've seen so far. True, we may never see a year that's worse than we've seen so far. But we might. Black swans do exist. Now let's turn to one of investing's most important concepts, diversification. I keep saying that there's no free lunch. In the investing world, though, diversification is pretty close. You already understand the basic idea because you've heard the adage, don't put all your eggs in one basket. The corresponding investment advice is, don't put all your money in one stock. Here's an example of diversification's benefits. Suppose that you have $2,000 to invest, and let's say that IBM and Coca-Cola Company are the only two companies in the world. You could put all of your money in IBM, all of it in Coca-Cola, or some in each. If you put all of it in IBM and it goes up 20%, then you have $2,400. Congratulations. If IBM declines by 20%, then you have just $1,600. Better luck next time. Or you could do the same with Coca-Cola, and you may or may not get the same result. Let's suppose that instead of putting all of your eggs in one basket, you diversify by putting $1,000 in each stock. If both IBM and Coca-Cola increase or decrease by 20%, then you haven't gained anything relative to plunging into one stock. But you haven't lost anything either. You'll have the same 20% increase or decrease either way. The benefits of diversification appear because IBM and Coca-Cola don't move together all the time. Sometimes IBM will increase while Coca-Cola will decrease. Your 20% gain on one offsets your loss on the other. Your good days won't be as good as if you put all your money into one stock, but your bad days won't be as bad either. We won't do the math, but you can prove that a portfolio of two assets doesn't cost you anything in terms of expected return compared to holding just one asset, and the returns will be less variable. That's pretty close to a free lunch. The gains from holding a well-diversified portfolio are dramatic. Just holding two different stocks instead of one decreases portfolio variation by about 25% on average, and holding three drops it about 40% on average. The gains get smaller as you add more stocks, and you'll capture most of the benefit by the time you're holding about 15 stocks. Your portfolio returns will vary only about half as much as if you held just one stock. That's an amazing reduction in risk. And remember, it doesn't cost you anything in terms of expected return. Your good days won't be as good, but your bad days won't be as bad either. On average, you'll get the same returns and eliminate some of the wild swings in value you'd otherwise face. No matter how many stocks you hold, though, you'll find you just can't reduce your portfolio returns variation to zero. You can't eliminate all risk. Even with 1,000 stocks, your portfolio returns will still vary about 40% as much as a single stock.